Hi folks, thanks for joining us in this week's Coffee Talk. Today we're going to be joined by Michael Watson, who's Executive General Manager, Head of Distribution at Latrobe Financial. And Michael, welcome aboard. Thanks for joining us today on Coffee Talk.
Hi Steve, thanks for having me.
Pleasure mate, pleasure. Look, one of the reasons that we're keen to get you on board today is that we have a lot of investors who are chasing yield, and at the moment with the official cash rate around 0.25%, it's pretty hard to find a decent yield. So we'd like to have a chat to you about your offerings at Latrobe, particularly around the 12-month term account.
Fantastic. Well, thanks for having me on board. I'm happy to have a chat with you right now.
Oh, no, a pleasure. Well, look, before we go through it, I'll just go through a couple of things, a bit of housekeeping. One of them, the first one is, this is general advice only. So it's all right, so we'll move on to Latrobe Financial, and I'll hand it over to you, Michael.
Wonderful. Well, thank you very much. Now, Steve, we've got some questions. Do you have questions lined up there?
I do indeed. So we'll just go through. So the questions today with Coffee Talk is mostly centered around who is Latrobe Financial. Tell me about the 12-month term account. And one of the questions that I get from time to time, because people haven't necessarily had a lot of exposure to Latrobe, is how safe's my money? So if you could work through those, that'd be great.
Absolutely. Thank you very much, Steve. And look, there's some very good questions. So thanks for putting them out there. I'll start with an introduction of Latrobe Financial. Now, some of your investors will know who we are. Some of you won't. So I'll just go with a bit of an overview. Latrobe Financial is a leading Australian fund manager with nearly 7 decades of experience solely in our asset class. So founded in 1952, we have a long history of successfully managing other people's money. With over $11 billion in assets under management, our investors range from household name global banks, Australian Big Four banks, Australian regional banks, international pension funds, local fund managers, right through to everyday Australian investors who might be saving for a home deposit or even investing their own super or SMSF money. Steve, your clients might be familiar with the award-winning Latrobe Australian Credit Fund, which is now at nearly $5 billion in assets under management. The fund has multiple investment offerings, including our classic notice account, our 90-day notice account, our 12-month term account, which you've asked me to speak about here as well, our peer-to-peer offering, and our 4-year term account. Each has a different liquidity profile to suit investors, but all are investing in the same underlying asset class, secured Australian property credit. Within that, our primary assets are loans to borrowers secured by registered first mortgages over property here in Australia. All of our loans are first approved by Latrobe Financial, and that's important to understand. Each loan is individually assessed by no less than 2 fully trained credit analysts. Our rigorous assessment methods ensure we're approving high quality investment grade assets to build highly granular and fully diversified portfolios. Each of the security properties is independently valued by a fully qualified property valuer, and we retain full recourse against our borrowers in the event of an arrears event. As a bit of background around the ownership, in 2017, Latrobe Financial was 80% acquired by US asset manager Blackstone, who you may be familiar with.
Sure.
Blackstone has over $500 billion in assets under management around the world and focus on the same asset class that we do. So being acquired by one of the world's largest leading investment firms is a wonderful testament to our approach to the asset class. They see value in what we do, and they share our views on the best way to manage this asset class.
Okay. So Michael, tell me a little bit about the 12-month term account, how that works, and I suppose what the current rate of interest is at the moment.
With pleasure. Thank you very much, Steve. Well, most people will consider the 12-month term account the fund flagship. Noting there's funds in the entire fund itself comprises around $4.86 billion in assets under management as at the end of August. Now, the 12-month term account itself comprises just over $3.4 billion. So the 12-month term account was established back in 2002. So as a strategy, has nearly 20 years history behind it. The focus of the 12-month term account is to provide regular income to investors across all cycles with low volatility. And we've been very successful in delivering this. So no investor in the 12-month term account, importantly, has lost a single cent of capital. Every monthly income distribution has been made on time and in full. And importantly as well, every maturity redemption has been made on time and in full. So a flawless track record of performance for our investors. We've been able to achieve that through its key features. So a key feature of the 12-month term account has been our commitment to diversification. We hold strategic allocations to assets across sectors, with residential loans being our largest holding, followed by loans secured by commercial properties, light industrial properties such as warehouses in business parks and the like, and smaller allocations to assets such as construction loans and vacant lands. We like vanilla loans, vanilla properties, the classic residential house, for example, rather than any non-standard or unique property types. And this is true across all our investment strategies, and it's fundamental to the investment program overall. Also with diversification, our loans are spread across the major capital cities and population centres, and that ensures there's geographic diversification too. The 12-month term account, Steve, holds the highest ratings in its category from ratings houses in Australia. It's also won, and this is an important one that your investors may recognise, it's won Money Magazine's Best of the Best award in its category for an amazing 11 consecutive years. So it's continuing to deliver premium income for investors throughout this low rate environment, and it forms the bedrock of many investors' portfolios.
Okay. So Michael, a lot of clients I have spoken to over the years about looking at Latrobe are quite keen to do it. And one of the questions is, Steve, how safe's my money? Do you think you could just go through that a little bit and just to sort of give a bit of insight about, investors' money and how safe it is?
Yeah, absolutely, Steve. With pleasure. It's a great question, and honestly, it's the single most important question that one of your investors would ask: how safe is the money?
Sure.
And first, the important thing for me to point out, first of all, is that we're not a bank. We're not regulated by APRA. Our investments are not part of the federal government's bank guarantee for the first $250,000 of money invested. That's an important starting point.
Okay.
And of course, as you know, and I'm sure you tell your clients as well, investing in any fund, credit funds and the like, is not without risk.
Sure.
But we're very aware that we are investing other people's money. In fact, there's over 47,000 active investors in the Latrobe Australian Credit Fund. So a really broad investor base that we're working with. In terms of how safe the money is, let me speak to the track record to start with. None of the portfolio accounts, and I mentioned we've got our classic notice account, our 90-day notice account, the 12-month term account we just spoke of a moment ago, or the 4-year account, have lost a cent of investor capital ever. These have structural features in addition to the great diversification and strong assets to protect investor money. Our peer-to-peer offering, which you'd be familiar with, where investors select individual mortgage assets to invest in, has experienced individual investor losses. We, of course, encourage investors in that category to take an active interest in the loans themselves or the assets that they're selecting. So in that category, we provide additional information, such as a supplementary product disclosure statement, details of the borrower's position, the loan purpose, and even a full copy of the valuation report on the secured property. But importantly, when it comes down to how safe is the money, for residential property, for example, the highest we'll lend to is 75% of a property's value. The maximum we lend to decreases for commercial properties, construction properties, and vacant land, etc., to ensure we always maintain a conservative overall security position. Using the 12-month term account as an example, the average loan exposure, so the average loan size in that portfolio as at 31 August 2020 is just $530,000, and the average loan to value ratio in there is just 63.4% of that security property's value. So this very granular exposure across a diversified portfolio of assets greatly reduces risk, and it's one of the reasons why no investor in this account has experienced a cent of capital loss, as I've mentioned. And of course, I always recommend our investors read our PDS, a copy of which can be found on our website, or of course speak to their financial advisor, such as your good self.
So I suppose, Michael, summing that up, having diversification throughout different capital cities in Australia, low LVRs, minimises the risk, which is consequently seeing that that no investor has suffered a loss in the 12-month term account, which would have to provide a little bit of, or fair bit of comfort to investors going forward, you'd think?
Yeah, absolutely. Look, we all know the saying that past performance and is no guarantee of future results and whatnot. But the 12-month term account was established in October 2002, so
Right.
it's 18 years into a very successful strategy, and that's a strategy that's
How
a
did you
strategy
go? Sorry, Michael. How did it go through the GFC?
Absolutely. So I was just about to say it's a strategy which has gone through the GFC with flawless liquidity. Same as I mentioned earlier, we've always paid out every monthly distribution on time and in full, and every maturity redemption on time and in full as well. So GFC, other business cycles that we've seen, including the most recent one through 2020 with the coronavirus effects. Likewise, it's the portfolio and the strategy has performed with flawless conduct throughout.
Fantastic. All right. Well, thanks, Michael, for joining us today in Coffee Talk. Really appreciate your time, and we'll no doubt catch up sometime soon.
Great, Steve. Thanks very much for having me.
Pleasure. And thanks, folks, for joining us, and look forward to seeing you again next week. See you later. Steve Maynes, Maynline Financial. Thank you. Bye.